Good morning, everybody. Welcome to the Flow Show, the day after the night before, and that CPI stuff. Morning, lads.
Hello. How are you?
Good morning.
Good morning.
Everyone all right?
All good. And you?
Yeah, not too bad. Not too bad. Kay, everything right with you, mate? All your diggers stopped digging?
And
the head stopped spinning?
Yeah, the noise outside is still a bit deafening, but I'm wearing headphones most of the day now. And the rest, the upper chamber is slowly healing, yeah. So
Good stuff.
hopefully I'll be able to concentrate for longer than half an hour today.
Yeah, good luck with that. Obviously, lots to talk about today. Obviously, yesterday's inflation numbers, we need to chew over what it means, and there's been more inflation today as well. But we will start, as we often do, in good old China. They announced their 1 year medium-term lending facility rate unchanged overnight at 2.75%. We've got another one coming up this weekend, another rate announcement this weekend as well. So just one to keep an eye on in case they decide to ease a bit, but unchanged on the 1 year MPR last night. The PBOC were out saying that they're going to push for more bank lendings to the private sector, and they vow expansion of the private enterprise financing support. So more, call it fiscal easing, monetary easing in one form or another to the economy in China there to help them get themselves back on track after the COVID blitz. Over in Hong Kong, the HKMA intervened in the market again for just under 15 billion Hong Kong dollars. As the price bounced off the top of the band again. That's a second day on the trot now they've intervened up there, as they can often do. Over in Japan, PM Kishida talking about Ueda, as if I'm getting that right, Ueda. How'd you say it, Kay?
Ueda.
You basically pronounce all the vowels.
Just think of UEFA, but with a D.
That's his name now, Mr. UEFA. Right. So anyway, PM Kishida was giving some comments on him yesterday, and says his appointment as the new BOJ governor was made after taking into consideration market impact. Not sure what market impact he's talking about. Anyway, he says the specifics of monetary policy should be carried out by the BOJ, and expects a new governor to keep appropriate monetary policy, taking into account the economy, inflation, and market situations, whatever situations may arise. So a few comments there. We're probably going to get more of the like up until we get these confirmation hearings next week. One man whose head is potentially on the block, RBA's low, was out yesterday and says that there's a risk that we have not yet done enough on interest rates. Monetary policy is restrictive, but not at the peak for rates just yet. Inflation is way too high and needs to come down, and that the bank will no longer be having lunch meetings before the statements on monetary policy are released, which is one of the things that's got him into hot water at the moment, because he was jawboning to hedge funds about where rates may go, and those comments suggested rates will maybe go higher than the bank are forecasting. So not a good thing for him to do as the governor of the RBA, and there's still lots of talk as to whether he'll get the chop and be replaced. Over in the UK, and a bit of Brexit news, which I tend to only touch on now and again because, like most things with the UK and Brexit, it drags on and on. We have been circling around the possibility of the Northern Ireland Protocol stuff being resolved, but we've heard that for weeks gone by. But apparently, according to the FT, the Brexit deal now meets the DUP's 7 red lines. This is the Northern Ireland party who have been sticking to their guns over negotiations, but according to the Telegraph, their conditions have been met, and Downing Street will declare that at some point. The FT said that Sunak will meet EU leaders to try and finalise a Brexit deal following that potential negotiation breakthrough. So something may be announced this week, towards the end of the week, or maybe never at all, as the things stand with stuff in Brexit. UK CPI out this morning, and numbers dropping back a bit further than expected. Core CPI 5.8% versus 6.2 expected and 6.3 prior. Headline CPI dropping more than expected to 10.1% versus 10.3 expected and 10.5 prior. The market is scaling down expectations for the Bank of England on these numbers. Rate probabilities has a 25 pip hike as a 74 pip chance. That was down from running in the 80s prior to the data. The other side is unchanged at 26%. Now, something I've mentioned previously here and other places to do with RPI and CPI. So let's look at the RPI number there, 13.4%, and this headline CPI number, 10.1%. UK phone, TV and broadband companies hike prices in the middle of the year based on these annual numbers plus their own little surcharge of 4%. So if firms using CPI, they will be looking at price rises of some 14%. If they use the RPI, they'll be looking at prices around about 18%, 17, 18%. So those are price rises that are going to happen in April or May, which means those inflation readings may be pushed higher. There's also other news out that childcare costs may be rising by 8%, also to come into play around about April or May. Throw in all these wage strikes going on, bus drivers getting 18% pay rises. There is still a lot of inflation potentially in the pipe to come into the numbers. At the very least, I don't expect inflation to continue falling or to start falling aggressively. Maybe not as much as we've seen now, but it still plays into my feeling that inflation isn't going to drop as fast in the UK, may even see it going back up, and it's going to push the Bank of England to hike a bit more and maybe for longer, which is not in the market's view at this moment. I don't know when I'm going to look to potentially trade that, because I think we've probably got a few months left to go. To say not going to happen till April, May, which means we won't see those readings coming in until at least June, when we get those numbers starting to come in May, June, reporting months. So plenty of time to go for that, but I'm keeping a very close eye on that and how lower Bank of England expectations go, because I think there is potentially a trade to come from that. Over to the ECB, and Centino said the full impact of rate hikes may not reach the economy, which is quite interesting because all through their easing cycle, the full impact of rate cuts didn't reach the economy either. ECB's Makrof said that the suggestion the ECB to cut rates this year is really going too far, and that the bank could raise rates above 3.5% and hold them there. So let's take a look back. Oh, jumping around there. Let's take a look back over the US CPI data yesterday and what went on there. So it beat expectations in both the core and the headline. 6.4 versus 6.2 expected, 5.6 versus 5.5 expected. So two beats there of expectations, but we did get a fall on the prior month, albeit a small one. A bit of a chop around in the market went on. Market didn't really know what to make of it. We saw dollar dump, dollar rally, dollar dump, dollar rally, yields up and down, very messy price action. But largely we're coming out of it with the dollar pretty much keeping to the same bias it had going into numbers, i.e. keeping a bit of a bid in. And I think perhaps the market is continuing what we've seen over the last couple of weeks, which is taking a bit more of a hawkish slant to things and continuing the fact that the Fed may be hiking continuously, if not possibly having to increase hikes. So rate expectations have ticked up. We're now pricing in the probabilities 25s and 50s rather than 25s and unchanged. Current probability is 89.5% for 25 and 10.5% for a 50 pip hike. Fed swaps are no longer pricing in a full rate cut for the end of 2023, and Fed Fund futures are implying a rate of 5.055% in December. That's off from a peak rate seen in July of 5.268%. So the market is now believing the ceiling numbers that are coming from the Fed, and that's the side we're leaning on at the moment. So what do you make of well, all the inflation data? Spain confirmed also a jump in inflation on the month rather than inflation pulling back, and they've been a bit of a leader. So what do you think, taking all this inflation data separately or as a whole, guys?
Well, I think it's definitely a surprise to the upside. You know, in my view, I thought it was going to go lower due to the calculation change. So that's oops, hold on. Actually, give me 2 seconds. If Kay wants to talk, I'll be back in 1 minute.
Okay, man. Yeah. Well, to me, if I take first of all, this CPI, it's I think it's all about the pace, and we see the pace is not there to come off lower. So the market has to reprice those yields, has to reprice, especially on the short end, right? You're looking at the short end of the curve having spiked a bit. I don't know what happened at the moment of publishing, because if you look at the yields, first of all, dropped and then went back up. I can't see any reason why even the 10-year dropped like 8 or 9 BPs at the moment of publishing. I failed to see the reason for that. So I'm actually thinking, I was thinking after the event, is that a fat finger or so? Because it's nothing warranted, those 8, 9 BPs drop at the moment of publishing. So yeah, to me, we are so this is the slowing of the pace. The dollar responded, albeit moderately, I would say, still. Because I do think that apart from the CPI number, the market is also taking into account what happened on better data. So we are now also firmly trading the soft or no landing or whatever. So we should see yields move a tad higher, but or higher if the market needs to reprice more. But if the data are holding up like they did at the end of last week, we are going to see a bit of how shall I say, pattern, which is if you trade a soft landing, that doesn't mean that the dollar is going to roar. It is, in my opinion, going to go higher, but then you're going to have a lot of correlations going on. Like, for instance, stocks are, let's just look at the S&P. It's holding up, right? You talk about higher yields, but then which should weigh on stocks, which it did initially, but we are somewhere in the middle of, I call it in the middle of nowhere. So I think through those correlations, I think the dollar will go.
I'm back. Sorry about that.
No, I think the dollar will go higher, but it may be a very uneven move. I'm small positioned in that sense, but I'm certainly don't refrain to take profit. So yeah, to recap, the pace has slowed, and now we have to wait for the next set of hard data, and perhaps today already we are going to know a bit more about those retail sales coming in, and we've got the New York Empire State Manufacturing Index, which has been a bit of a leader, very volatile number, but and then the IP for January coming in after that as well. So I think we have to look at the whole the global picture right now, and again, I think it's going to be one of a higher dollar in a way, but quite uneven. It could be very uneven moves. And you need to select your counter currency as well. I mean, if you look, for instance, okay, dollar mix is a bit higher now, but if you look at those things, the mix is actually holding up pretty well because it's going to benefit from US doing well. In a way, but then if you look at stuff like yen, now that Ueda has been saying it might not be a big game changer or like a massive move to be expected, dollar yen is probably prone to go in for a revisit of 134.5. But is it going to go one-way ticket? I don't know. I really don't know.
Yeah, no, exactly. Still, you've plugged yourself in?
Yeah, I'm back. Yeah, I'm back. So, so my view on CPI yesterday and the implications. I actually wrote a blog post about it. Let me put the link to that. Hold on.
You got it? Because I was gonna stick it up.
Oh, got it.
Yeah.
Okay. So let me put this up here, everyone. So I think this number is does change things. At least for the short term. And I was talking before the number about how this tug of war between the Fed and the markets has been ongoing, and at some point something's got to give. I think that this number is strong enough to be able to, at least in the short term, change things. So I think the market's pricing now almost 75 basis points of cuts. We were pricing 50, a couple of weeks ago. Now we're almost at 325 base point hikes, and also which is not unreasonable, but also we're pricing a full cut by the end of Q1 next year. That part of the curve, I think, is not right. I think the Fed, especially if inflation seems to be easing off, at least this is the indication now. There's no way the Fed's gonna hike, and then start cutting as quickly as the market expects. So I think that there will be, or there has to be, some kind of correction in yields from 2 years out. The very short end, it's moving a little bit here, shifting probabilities on one hike to the next, etc. But I think there should be a correction in yields higher. And we've been talking about yields being low and the curve being very inverted for a while now. And I think we're getting now to the point where something's really got to give. And what I think is going to happen is yields correcting. So if yields correct higher, by that I mean, 10-year US maybe goes towards those previous highs at 433. I think it's very doable, and it could be done in a very short period of time. Then that is going to put downward pressure on risk. It makes a lot of sense to be short equities, but that's a problem. It makes a lot of sense. So maybe positioning is still tilted this way, and the path of least resistance is still to the upside, at least in the very short term. And we saw this from the move yesterday. I mean, we had really strong inflation print everywhere. Every component, it looked a lot stronger than expected. And yet the market initially sold off a little bit, then it rallied back, and then sold off again, rallied back. It's like stops taken everywhere. I still think equities are trading very, very strongly. They're very resilient. I don't understand why. Maybe it's positioning. Maybe actually I don't know why. So the problem with this trade is that it makes a lot of sense. So if you put a gun to my head, I want to sell S&Ps, but look how close we are to 4,200, which is a major breakout point. So, yes.
I think you didn't listen to what I said before because you were off desk. I said that this is typical for a soft landing or no landing trades, right? Your equity markets are somewhere going to hold up, and I think you put the finger on a very, very good point in regards to why the dollar isn't really ramping higher is because the curve has inverted more, and usually a deep inverted curve is not very positive dollars, right? So in the end, I think the market is trading several things at the same time. But I agree with you. If we continue, if The longer end of the curve starts to correct as well because of data. And I'm actually a little bit surprised it didn't correct more yet because of the strong data that we had. There, I think your dollar is really going to take off, and risk may then get a knock on the head. But as long as this curve remains inverted as it is, and the market is happy to trade a soft landing or even no landing, we might just see these equity markets hold up, and the dollar, as I said, I mean, going up, but at a very uneven pace.
Yeah, no landing scenario. I mean, that happens. Yeah, that's a great scenario for the Fed. You know, they will avoid a market crash, and they will, you know, bring eventually inflation under control. This is what they want, but maybe that's what we're trading. I don't know. It's really difficult. But you know, if you put a gun to my head, I really want to sell equities. But as I said before, 4,200 the S&P is huge. You know, if that gets broken, you know, the next 100 points are pretty quick, I think. So, yeah. And the dollar is not doing much either. It looks like the only thing that's moving once again is precious metals going lower. Even Bitcoin is unchanged. It's like, it doesn't make sense. It doesn't make sense. Any way you look at it, it just doesn't make sense, at least to me.
Yeah. This is one of those times that mentioned where, you know, we're in ripples. You know, it's hard to pick a side, to pick a trend. You know, it was only 2-3 weeks ago we were still trading the pivot. Market was pricing in rate cuts. Everything was about when's the rate cut coming, and now 2 weeks later we're talking about maybe rates, you know, at least going to the ceiling, maybe even higher. That's the nature of markets at the moment. That's the nature of watching the data, is that you're going to get these swings. If we suddenly get a bad NFP, bad retail sales, lower PPI, you know, the market suddenly switches again, and it's very hard to grasp a trend. You really have to see data performing. Why it's so important this first quarter, this first half of the year is going to be important for data to see where the trend is. Is it going to be a soft landing, no landing? We still might get a hard landing. You just don't know. So for now, it's difficult to take a real side and say, yeah, I'm going to sit on this for 6 months or whatever, because we can change in a flick of a switch. And in that sense, you know, if you're not a long-term trader, it's good for your short-term trades, because you're going to find the ranges developing. The market's going to push one side, won't get through a level, and it'll push the other side. And if it doesn't get through that level, then you're in a range and you trade it until it breaks. You know, I'm looking at exactly the same thing with dollar yen, and I'll talk about that once I've finished the headlines, because it's there's evidence growing that I'm wrong in my thinking, so I need to adjust that with my trading. So let's finish off and just go over what some of the Fed heads thought of the CPI report. Barkin was on Bloomberg TV right after the numbers. He said the report is about what was expected, and says there's going to be a lot more inertia and persistence to inflation that we want. There's a very good case for leaving rates higher for a longer period of time. But he did say we may or may not choose to take rates up further if inflation persists. Fed's Logan said we must be prepared to keep raising interest rates for longer than anticipated if needed. And even after pausing rate hikes, need to stay flexible and tighten further if conditions call for it. Then she needs continued gradual rate hikes until she sees convincing evidence inflation is falling to 2% in a sustainable and timely way. And tightening policy too little is the top risk. Fed's Harker was out saying at some point this year, I expect policy to be restrictive enough to hold rates in place. The Fed is not done yet, but we are likely close. Doesn't see the need to continue above 5% in 25 pip increments for a while. So his ceiling is at 5%. We know where his dot is on the list. Williams still have a ways to go to control inflation levels. Recent data supports the case for more rate rises. The outlook for year-end Fed funds rate of between 5 and 5.5% looks reasonable. Possible that the Fed cuts rates in 2024 or 2025 to reflect lower inflation. Even Biden was out with some comments saying the CPI data shows still more work to do on inflation. He also confirmed that Brainard will be moving to the government as his top economic advisor. Her resignation is said to be effective around the 20th of Feb. So she's off, which means we're going to get a new vice chair in at the Fed.
And she's a, remember, right? She's the big dove.
Yeah. Well, she's been a bit more, tad more hawkish of late, but
Of late, yeah, maybe, yeah, of late, yeah.
Yeah, but it's still going to be a big change there, and we'll have to see who comes in. I'm not sure if any names have been bandied around yet. So just I want to talk quickly about dollar yen because this is a short I've been in for some time. Let me get my little zone up, and I'm just with the data that's coming out from the US, just the way the market's turned. I am questioning my short positions. I'm short from the high 130s up to 132.77, I think it is, my highest entry. I have let some go in the dips when we got them, so I've taken some money off the table. And I'm just wondering, I've been expecting the dollar to rally up since we found these lows of 127. Been saying here pretty much every show, face and whatever. So I'm not going to be surprised if we do ramp higher. This 134 is going to be a big area. The data is changing. As I said, it could be a short-term thing. It might not be. It might be a longer-term thing. The jobs market's holding up. CPI, maybe the drop is slowing. The other data may be picking up. So the evidence is building why perhaps I'm wrong in this trade, or maybe that I'm not wrong, but the market may go further and I want to let it go for my position. So I am considering maybe cutting out my position. I've got an idea of a stop at 135 anyway. So I may leave it to that and see how we do at this 134s. But if the numbers still keep coming in strongly and if the economy does look like it might be taking off again, I might look to exit that position with the prospect of reloading much higher if we get up to some other juicy levels, up to maybe the 137s, 38s, 39s, that sort of area. Because I do think if the data does keep going, we are going to see some further upside in the dollar. And like Stel says, yields ramping higher as well. So I'm not one to stay in a position if I have reason to think that I'm really wrong. Obviously, the Bank of Japan consideration is still in there. Still a bit of an unknown what exactly Ueda's going to do with policy. So if he is a complete Kuroda Mark II, then again, that puts me on the wrong side of the trade and we see the yen weaken some as well. So a double wind perhaps for dollar yen moving higher. So that's my thought on dollar yen, and the guys will obviously come in with their thoughts as well. But for now, let's see if we get a move up to this 134. Let's see what happens. If it does show up as resistance again, then we maybe stay in a box and we've got a decent range to play until something changes. So a bit of something for everyone to trade there. One of my other positions was the short Hong Kong, US Hong Kong dollar, and that intervention. Well, I was around last night when that intervention dropped and there wasn't a move at all over it, but I don't know what happened here, but later in the day got a dip down to the 35s and I got some of my partial profits done at 84.50. So I'm going to be playing that game, 84.50, 84s for some, reloading in the rallies back towards the top there. So touch wood, that's going okay for now. Dollar yuan as well, that's made a move up above the 84 handle. Oh, let's go into the right one. There we go, back above that old fib, and it's also a prior level on its own, around 84. So you can see from that prior high there, then we had the break above, became support. So we're sitting above the 6.84. Happy to let that ride. I might start pulling my stops up behind now, lock it all in. I took some off at 6.8550s. So finally going my way. Next level to look at is up towards 688, 89, and then the big 690, 91. to come next. Just looking around some of the other pairs as well. Aussie dollar looking weak again. And I said if we couldn't get and hold above this 70, and we had another go yesterday over the data, and we've come back all the way down very quickly. I'm getting an itch that we might be breaking this area and heading even lower. But it's going to be a level until it's not, as we like to say. So this 70, 80, 68, 70, 80 zone is going to be very important if we get a test today, and look at this 68.50 as a bit of a final line, a bit of a confirmation. If we get under there and hold under there, that'll confirm this break probably if it happens. Conversely, if we do bounce off here, then it keeps the range in play between the bands, and we're going to be waiting on something to kick us out of it significantly. So that's just a couple of thoughts on a few pairs at the moment. Mike asks, would you dismiss dollar yen shorts covering given the US rates? Would I dismiss? No, I wouldn't dismiss shorts covering. But conversely, you know, dollar yen, you could say, well, there's plenty of longs who have been buying it, who are buying it off the levels down here. The market isn't always short. There are people who actually like to go long in markets. So, as you know, you've been here watching the show long enough. I've said for a long while, I expect this to be going higher. We're saying it even as we were coming down. This might be a point where we stop and then turn around. So, yeah, there may be some short covering. If it ain't going down, there's only one way it can go, and people are going to trade that way regardless. Lads, do you want to anything you want to pick up in particular?
One thing I wanted to say about dollar yen, I think my base case scenario is that yields are going to start moving higher, and that means that the dollar yen theoretically should follow. There's a good correlation, and also if you look at the technical picture, we bounced off the 50% fib from the December lows, December 20 lows to the October 22 highs. 50% retracement was pretty much spot on at 128, which was a low, and also
this one here, mate.
Yes, and also we are now moving pretty convincingly above the 50 DMA. This started yesterday and it's continuing today. So I like it technically. I like it on a macro level as well, because I do think yields are going to be rising, at least in the short term, and the dollar is going to follow. So plus being long, this gives you a nice carry, right? So triple whammy. I think I like this trade to the upside. Where's what levels would I look to the upside? Well, the 200 DMA at 136.5 or whatever that is, that should be a nice first target, but I think potentially we could have a lot more to go.
Yeah, maybe a bit of confluence building up here with the M&As and the old fib levels, and that's the 137 high 137 138 is a level on its own. So get these MAs moving up here. Technically you're going to have a lot of action going on there, and I do like a bit of confluence, particularly on charts like the dailies, for trading. If you're looking at charts and looking for indicators, and if you get several all in around a close area, you've got to have a crack at it, I think, because the tech pictures don't often get as strong as that.
And confluence just increases your confidence on confidence. There you go, on something happening. It doesn't mean it's going to happen, but it's just every little extra that you can get that reinforces a view. I like that.
Yeah. Okay, you going to say something?
Yeah, I'm going to show dollar yen if you don't mind, because I'm the other side of your trade,
yeah, go ahead. One thing I just wanted to point out quickly that and I've noticed this the last couple of days, and particularly in the afternoon. I don't know if it's a fixed thing, but yen weakness has been a big driver of moves the last couple of afternoons. And when I've watched yields, it's gone against the yield move. So, yields are edging down off those highs we saw yesterday, but dollar yen's holding up. So it's a slight disconnect, at least intraday, on the yield dollar yen or yield yen move. So keep an eye on that. And as I say, the last couple of afternoons I've seen all the yen pairs rallying, and it's dragged up the majors. And I'm not sure if it's some fixed stuff going on, but just one thing to keep an eye on. Take it away, Kay.
Hoi hoi. Yeah, so I'm going to show this again, and just while I was looking at your chart, and I know Ryan, you're not a fan of head and shoulders, but if we look at this, we could be in the process of building one, and that would be somewhere back to 138.5, 139 or so, and then if that's a bigger head and shoulder pattern, it's possible, right? But the one that I've been looking at, so people who were live on Face yesterday, they know what I did. So I bought the dip live on Face, 130, 160, and
it's like the movie. I know what you did last webinar.
Mm-hmm.
Oh, that's bad.
Yeah.
That's
and
bad,
then we've
mate.
had, and now there's a couple of things happening. So first of all, and let me first of all go back to what's happening with Ueda and the Bank of Japan. Kishida is pretty well in Japanese, which is always a split tongue comments or difficult to translate exactly what they are saying, but they are, and I've been saying that, gradually probably going to normalize, right? So that has not changed, and there may be moves in the future, but we have to know one thing about Ueda is that he was somewhere and one of the architects of zero interest rate policy back in the early 2000s. So he's not the guy, in my opinion anyway, he's not the guy who is going to ramp Japanese yields up to 2% or 2.5% as soon as he sits down. So the move that we saw when the Bank of Japan widened the band, giving a confirmation to the market that they may be doing something, has attracted a lot of flows, saying now, okay, this is the end. 2023 is the year of the yen, and there's been a lot of energy put in that. And I think what we're seeing now, helped by the dollar, of course, because in the short term and in the day-to-day business, we are trading on the back of the US 10s, but there's this Bank of Japan thing lingering in the background, of course. And as Ryan said, on the 24th, this Parliament is coming together, and we'll have a hearing with Ueda and his supposed deputies, and we'll probably see some moves on the back of it as well. But I still think that the market may have gone a little bit far in pricing in this Bank of Japan changing of direction, because in my personal opinion, they are always going to be slower than the rest, especially if now the US needs to continue to hike for a little bit longer than expected. We need to price out rate cuts this year. This may go a little bit further before the Bank of Japan actually acts. Next Bank of Japan meeting is the 10th of March, and we're reading stuff people saying that hey, perhaps Kuroda will go out with a bang and change monetary policy there as well. So we are going to see speculation about what may happen early March as well. So there's going to be a couple of important rendezvous in the future. But in the meantime, so
that's quite funny, Kate, because you've pretty much repeated everything I said on the webinar on the Flow Show yesterday regarding Ueda, because I said I think the market's gone over dovish on him, and why would Kishida replace like if he wants a change?
You mean the market has gone over hawkish?
Over dovish I think the market has gone over dovish on Ueda in this rally up in yen pairs, because why would Kishida go for a like for like swap for the reasons you said? Kuroda and Amamiya, the proponents of the easy policy, are they going to be the ones to take them out? And the answer is probably no. So Ueda is possibly a change.
Oh, it will be, because he's that's what I'm saying. We are in a normalization process, but I think where the market overreacted on what it could mean that Aramea is not there, I think the market equally overreacted to on the way down to on the way.
Gotcha. Yeah, I was saying they overreacted on the other side as well when he came out with those comments.
I'm not plagiating anyone, Mike. You don't know me if you think that.
No, definitely not plagiarism. We all share our views.
So first of all, and then let's look a little bit at the price action. So we've had those several tops in dollar yen close to 133. So that's a first level. I think here pretty important level. And then if you overlay the daily Ichimoku cloud, that also comes in at around 133, and we are entering back into the cloud. And the Japanese crowd really loves their Ichimoku clouds, and we are attempting to get back into it. Over the next few days, this is going to be moving lower because the cloud is always a delayed. It's based on moving averages and stuff anyway. So it's going to move lower a little bit, but at least for today, it's still around 133. So that on the day makes this 133 quite an important level. So we have US data out later on, so that can be the clincher. So what happened is that yesterday I bought this. Hang on a minute. Yeah, I bought this here, this dip here, and then I've sold it out against 133. But then later in the evening, seeing the 132.5 bounce, I've bought small back, and I'm still in that one, and I'm going to watch carefully what the US data are going to do, because as I said, to me it's if we have to continue to buy dollars, data will have to be supportive as well. To me, now we have had the CPI, it's back to real data. So today the pivot level of the dollar yen is clearly 133, call it 132.90. If tonight we close below, I'm probably going to log mine out. The ones that I bought yesterday is around 132.70, 72. So it's a very low risk trade right now, because I still, as Ryan was also saying, it's tough to be married to positions, and I'd rather not for the time being be married to big positions. But anyway, to me, it could be that we are going to move a bit higher if the market needs to reprice one bit of over expectations on UEDA, and two, if the US data hold up and take the yields back higher. So assuming then that this picture is right, and then Ryan was already talking about 138, the 200 is a bit lower, but if you look at the 100 is also around 138. And then we have the top of the cloud. I think it may be a little bit over optimistic to go and have a look back at 139, but who knows? You know, in Yenland, and this is going to come off. So perhaps if we continue this pattern higher, it is going to be stopping somewhere in the 137s. But having said all that, to me, the next big level is going to be here, this one here. We've had double tries out, a bottom here and a bottom there. 134.5, 135 is really going to be the gateway. And as things stands, my plan is to really take profit in that zone, and then we will see if we have to get higher again. But to me, if we get there, I'll be a happy camper right now, because I don't know whether there's enough strength on the one hand in the dollar and enough weakness on the yen to go up much above that straight away. So that for the yen. Another one trying to make a move for it is euro yen, and that is looking a little bit like a fakie right now. I've been long a little bit of this one as well. Took it out this morning and then trying to go with a break above these levels, but I think I'm going to swallow 15, 20 points on that one and just call it a day, because we stopped right on the 61.8 as well. So it may start to look a bit fakey, this one, if it goes back below, well, call it 75, 90 or so. Gavin, a lot of the end process look like they are around tops, and yeah, I see what you mean. I think the sterling yen is printing pretty much similar picture, right? We had a run through on the sterling yen, but we are failing to take out the December top, and we're already back into this wedge here. So they may be looking a little bit fakey on the breakout. So perhaps it's still a better plan if you want to be short yen to trade it via the dollar or some other cross. If you like exotism, makes yen is a diabolic carry trade if you want to have something sexy on. Cable. It's trying to make up its mind around this 120, 70, 75 zone. We had this drop yesterday also. We were talking on Face about this 122.60s, and that's exactly where it stopped. And then we had this this drop in uneven drop, because in the meantime we also came back up to higher levels before the CPI came out this morning. Really. I don't know if the CPI in the UK is coming off. Ryan has really a lot of valid points about what's going to happen on the retail price index and everything. This CPI is going to be stubborn, I think. But again, and then I reiterate for those who may not have been following the flow show for a long while, it's not because the CPI is high that the currency has to strengthen. Actually, in economic terms, it's the opposite. And if you want to look for some historic facts and figures and moves on the back of high or low inflation, just look at what the Deutsche Mark was doing before the euro was created, and look at what the yen has been doing when we were in deflation. The yen never has been stronger than when the deflation was at its strongest point in Japan. So again, I just want to say, I mean, we can have central bank expectations, and I think Ryan actually is right. I think the Bank of England will be forced to go higher than the market expects, but how long or how much effect this is going to have on the currency, that's the real data going to tell us. Because if despite all wage hikes, the public loses everything in just needing to pay more for energy, needing to pay more for his phone bills, it's unlikely that it's going to help the currency much. That's just my personal view. Oh, look at this. That's another interesting little level here where we stopped right on there, 120.65. So yeah, on the cable, have a look at how it goes here, perhaps after the US data later on today. Euro sterling bounced. We tried to go below, and I think that's the somewhere the Northern Ireland impact as well, and the market being perhaps a bit too trigger happy buying euro sterling along this trend line. Few stops been taken, but now we bounced quite severely, and we are in the first resistance area. So keep an eye on what's happening around 80 here in the euro sterling. I still have I still have my option running, and I'm going to do exactly the same, unhedge on the way up, and then buy back if we are sub 88.5. I have not added any cash because I'm still a bit unsure about really the viability of the sterling weakness right now. But if it goes up anyway, it's going to be my direction. Another one I wanted to show is dollar Mexico. Mexico 1850, 1840s. It's holding for the time being. It is holding. So I wouldn't fight this. I wouldn't fight this for now. I still think the MEX is a candidate to do very well. But depending on the US data, we may have put in a bottom here, and why not? We could at least go back to 1880s, why not even 1919s, before reassessing on the dollar side. Okay, on the dollar side. On cross side, it's a different story. I still think this is looking weak. Yes, we are holding around the prior low here. Yes, it's rebounding a bit with the dollar mix, but as long as we can't take back 2015, 2025 levels and go more neutral, I still think the carry trade is still very much alive. That's for the mix. Yeah, I could look at other stuff, but yeah, dollar China, interesting that we stopped right here. Nice take profit there, Ryan, overnight. Well done, mate. So that's that to me is our gateway to 690, really. 685, the high 685, 686. If it breaks above there, then I think we're going to trade 690. Where I look to take the rest of my my little, it's really small right now, but I'm looking to take it off up there on a first run up to 690. And I'm going to stop it there because I'm looking at the time as well, Ryan. I'm going to give it back to you.
That's right. Do you want to look at Mex Yen? I don't know if you've got Mex Yen, Catherine. That seems like one hell of a carry trade.
Yeah. I'm going to look at it, but I don't. Well, you know what? I'm having actually the position, but through the legs. Because I'm long Euro Yen and short Euro Mex. But I was a bit over cautious on this one. Catherine, is it who was asking the question?
Yeah.
Okay. I was a bit overcautious on this one. I was hoping to get it back or around those lower lows when it was trading here, and I said like I had actually a bidding and never got filled, of course. But this one is looking like we could trade it higher again, yeah. And it's a hell of a carry trade. Okay, if you look at it here and oops, this and then perhaps here, but then more likely. So we are in this channel. So be a little bit careful what happens. If we get up to 720 here, could be a bit of an intermediate station. But I think it's still a good carry trade, and you're getting a lot of money. Look at this 720. There's your level here. But it's still looking pretty good. So on the underside, have a look at what happens in the low sevens. Get back down there and it holds. That's probably the key to your next leg higher here. But for the time being, a bit cautious here. All right, and I think it may have sparked a bit of that dollar mix as well. Buying because we found some offers here. So yeah, but global picture, I think we're back looking gradually higher again, and you're getting paid for being long on this. Right.
Cool. Thank you, mate. I shall grab it back just quickly because we do have a couple of requests. Let's have a look. Peter on the Q&A asking about Aussie Swiss. Is it too late to short it? Well, looking at that big fat red candle, I would say yes, you are a bit late if you want to short it, but we are on some key levels. You know, we're talking about confluence of tech, and right down here we've got the 55 and 100 DMA. We got the 50 fib of this move up from December. So you've got a bit of support around here. If you want to short it, your best bet is to try and look for a break. Potentially, I tell you what, I don't trade this one often. I couldn't tell you if I even traded it. But technically, here's your support level. If you're under there, you're on for a potential break lower. Two ways you can do it. You can trade the break, maybe of the 100 DMA, stop back above the 50 fib as a secondary area, or you wait, let it break and see if it comes up and starts holding these levels as resistance. Look for the confirmation. get a move under, bounce up, start seeing closes below this level or the 100 MA, then that gives you a bit of confidence to get a move further down. But it's always a way, if you've got a bias, you think you've missed something, don't just jump in with FOMO, give yourself a reason to trade it. Go through the charts, look at your levels. Is there a level you'd be happy to short a bounce to? You've got to say round about this sort of area, 64, 64 and a half is where you want to perhaps be looking at. If we get a bounce to that level, that's maybe somewhere you want to look to short. Again, you don't need to keep, you don't need to throw the farm at it. Maybe use that 100 H4 as your stop level, as your final line in the sand. If you're above there, likely you're wrong. So there's plenty of ways to skin a cat in this game. You can see we're looking for a breakdown here, but it's not quite getting through. Having little moves under, but it's not holding under. Look for the confirmation that a move is going to continue before you jump back onto it. Ali has got himself stuck in a Euro Swiss long, so we're staying on the Swiss. He wants to know a bit about the fundamentals. The S&B are on the hawkish side. Their meetings are only once every quarter. The next one is in March, I think the middle of March. They have been threatening further rate hikes, although they haven't hiked of late. They are getting more worried that inflation is more persistent. The economy is doing pretty much what everyone else is, following the same sort of themes, so no real differences coming out of that. But as I say, they are quarterly on their monetary policy meetings, even though they can threaten to change rates in between meetings and have done so in the past. So really the fundamentals, you're going to be looking at what the S&B might be doing on rate hikes. Let's have a quick look for you on the...
Ryan, sorry to interrupt. I would argue that the S&B's FX operations are a lot more important than their monetary policy, but maybe both. But this is a currency that I hate trading because of the S&B. Because they can come in the next day and do something unexpected. And I mean, obviously every central bank can do something unexpected, but in terms of their currency, the S&B are the champions. So I hate this currency. Sorry. Also, why would you want to skin a cat? Where did that expression come from? I mean, seriously.
Skin a cat. I don't know. There's many of those sayings, and we all say it, and no one has a clue where they come from. You have to look that one up.
People were hungry. Yeah, maybe.
Yeah, exactly. But back to the S&B, the current rate probabilities, a 50 pip hike is currently running at 68.9%, a 25, the difference at 31.1%. So the market looking for a 50 pip hike at their next meeting in March. So you know where the expectation lies. If you are in a trade and you're wrong and you're not sure what to do with it, go with your original plan. You would have had a stop, I would hope, in play, where if you were wrong, that's where you get out. If you haven't got that at the moment, you need to get that in. Decide where you are wrong. Take the bullet if you need to. Don't let pride get in the way of a bad trade. Without you giving us further details, your plan in the first place, it's a bit hard for us to give you sort of any real advice. But certainly at the moment, what are you? You're stuck in a long. I don't know where you're long from. Whether it's around here, whether it's lower down, whether it's up here somewhere. So just plan your pain level.
On what, on Euro Swiss?
Yeah.
I'd be very careful above parity because we've seen several attempts to get up there and it's not holding. It's just my view. This is one of the currencies that has a very low interest rate, still comparable to all the rest. But couple of months ago, SMB gave the market at least the green light to buy Swiss, and and I'm just giving it. I don't have a position, but I'm rather a buyer of Swiss on dips just for trading it, because of this SMB. They are both ways in the market right now, and when Euro Swiss rallies, they will probably lean on it, parity and above, and then when you come back down to 97.5 and below, there's a risk of them being on the bid. So, but the global expectation for 2023, just after reading some Swiss research and stuff, is that the Swiss should gradually gradually. That could be like really snail's pace, strengthen a little bit more this year. So I don't want to sound too alarming, but if I would be long Euro Swiss and I'd see it above parity, I'd start to look at it closely and see if it holds or not.
Yeah. So just to clarify, you said you'd be a buyer of dips in the Swiss, so i.e. selling Euro Swiss if it rallied.
Me, yeah.
Yeah. Just want to confirm that, just in case people misheard and thought you meant dip buying in Euro Swiss.
No, I'm a dip buyer of Swiss franc, but you can't hold it for too long because it costs money, right? Yeah,
exactly. So you're long, Ali's just come in. He's long from parity 30. I've removed half my position in profit. My stop is at 98.20. Okay, so you've got you got a stop in play. So yeah, okay, you're good, but looking a bit tough, as Kay says. It doesn't hold for long above parity. So I think if you get an opportunity from the SMB, if they give you something or anything else gives something, you might want to look at a get out of jail free card on that one and reassess against this parity level. It's a bit of a pivot. If it goes under, then it tends to hold and carry on down. So keep an eye on that one, and good luck to your trade. I hope you bank it all in profit, mate. Right, another day goes under the bridge for the Flow Show. Anyway, thank you as always to you viewers for coming and watching us and giving us your support. Always appreciated. Love hearing your conversations, your comments, and answering any questions you have. Thanks as always to the two amigos, Kay and Stel, for all their helpful, insightful knowledge. Thanks, guys.
Thank you, Ryan, and everybody for being here.
Thanks, guys. Have a good day.
Cheers all. Yeah, we will see you all again tomorrow. It's Friday, I think, isn't it? Friday. Brilliant. No, it's Thursday tomorrow. Oh, damn it. 2 more days to go. See you guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.